Hi, this is Ben Rayo, and welcome to this episode. I want to talk to you about structuring your deals and some different things to think about when you're buying investment property. There's a lot of different choices on how you can finance and structure deals, and I just want to spend a few minutes to talk about a couple of high-level ideas on what you can do. One of my favorite ways to do a deal is to get the seller to hold back a note. This is great because you don't need credit. You can structure the deal kind of any way that you want. It's a pretty simple deal. The property can go into your name. The seller just becomes basically the bank in this scenario. So, for example, when we bought these duplexes on this project, we bought them and the seller held back a note at 6%, and they did a one-year note. That gives me enough time to get the property bought, get tenants into it after it's rehabbed, and then I'm in a much better position and have more options on how I want to get it refinanced. So having the seller hold back a note is not as difficult as you think. There are hundreds of thousands of people out there doing it. People are stuck in properties for a lot of different reasons. So don't be bashful about asking somebody that's selling a property, hey, would you hold back a note? Maybe they'll just ask you to put $5,000 down, $10,000 down. It's a great way to buy yourself some time, get a competitive rate. You don't have a lot of closing costs. So it's really a great strategy that I love. The next one I like is joint ventures. So joint venture, I really like this one, or you hear a lot of people talk about JVs. That's really the cool way to do it. But I like this because there's so much creativity that goes into this. I'll give you an example of a deal that I've done. So let's say I was buying a property and I didn't have any money at all to buy the property. It was a good deal. Somebody, because I'd had my brand out there in marketing, I wasn't in a position to go borrow the money or do it fast. I had somebody kind of on the line that wanted to invest in real estate. They actually put the money 100% in to do the deal. I managed the entire deal, was able to get it rehabbed and flipped over a 6-month period. Now, the neat part about all of this is that you can structure the terms any way you want. You can structure the terms to say, I'm just going to pay you a flat interest rate. You can structure the terms to say it's going to be interest rate, plus you're going to do a percentage of the profit, or maybe you're just going to do a percentage of the profit and it'll be a split. So joint venture is a good creative way. If you have credit issues or you don't have the money, then this is a good way to find people that want to get into real estate. So this kind of goes back to our first segment about building your brand, people bringing deals to you and things happening very fast. Great way to do that. The next one is 401k. I really like this option. A lot of people work for classical companies. They've had a retirement fund of some kind. This is a great way to get access to money. I've taken my 401k and rolled it over into an IRA custodian that focuses on allowing people to self-direct an investment, so self-directed IRAs. I've used Equity Trust for years. I like them. There's other choices out there, but that's who I've used. So I put my money there, I found deals, and then allowed my 401k to actually be the money to fund that deal. You definitely need to talk to somebody that's a 401k custodian and get all the T's and C's and what you're supposed to do and the do's and don'ts, because there are some regulations and things around it. But it's a great way to get money out without having to go borrow it. You're basically borrowing it from yourself, and then when you put that money into a property and you flip it, the proceeds from that go back to your IRA, which typically would not be taxed because that's a retirement fund. So that's one way to push off tax consequences with gains. Again, talk to your accountant, talk to an attorney, talk to the compliance people, the 401k custodian, but this is a great way to do it. There's also a huge network out there of private lenders. So private lenders can be anything from somebody that has $100,000 that they want to loan you to hundreds of thousands, if not millions of dollars that loan. There's people all over the country who do it. So private lending is a great option. And I'm really excited about this because I didn't even know about it 5 years ago, which is crazy because it's been out there for a long time. But really what's happened is that there's a lot of companies out there that are small companies that have big funds. And when I mean big funds, could be $500,000, could be $100 million. But they're focusing on working with real estate investors, doing more short-term loans to give me the ability to borrow money, do a deal, buy it, fix it up, flip it, and then pay them back. Interest rate maybe a little bit higher than normal. It's not your classical interest rate of what your home loan would be, but it's a great option. And the best part is it's not so much about your credit or the paperwork and debt to income. It's more about the asset. So they want to see, is this asset worth $200,000? Great, we're going to loan you $100,000 or whatever they may loan you on it. And it's really about the asset. So great option to find money. Now, one of the neat things you can do is that you can take a couple of different of these options and mix it up. So, that might be something that's a combo option. So you might have some 401k money and maybe have $50,000 in your 401k. You want to do a $200,000 deal? Maybe you take your 401k money and you put it together with a private lender that gets you down your equity position down, so then the private lender will lend you the money. Let's just say it's a $200,000 deal and you've got $50,000 in your 401k. You may be able to pull that out, have your 401k buy a portion of that deal, and then you may be able to go to a private lender because the equity position is very different because the 50K is in the deal, and now go borrow that money, put that together, and you didn't have any money out of your own pocket. It was still your money, so then when you go to sell the deal, yeah, some tax consequences on the money you borrowed, but then your 401k gets part of that profit too. So again, you need to talk to a CPA. Everybody's a little bit different. You need to make sure you're talking to compliance from a 401k, self-directed 401k custodian, but great way. You can get really creative. So you can even mix it up to have joint venture and 401k and maybe a seller finance. So let's say you buy a property for $200,000. Seller is willing to hold back $100,000. You take your 401k, maybe you're buying a portion of that property, $50,000. We'll just use that number to throw it in. It's simple math. Maybe you needed to pay the seller $25,000 as a down payment. They financed $100,000. The other $25,000 was used to fix the property up. Now you earn it at $150. You sell it for $200 or whatever it is. It's just, there's a lot of different creative ways. So I would not let money or not getting access to money be the reason why you don't do real estate investment deals, because there's a lot of different ways to do this. There's a lot of different resources that you can check out, and we'll be working towards getting those onto our website as far as getting some experts plugged in that can give you a better idea on how you might do deals. I'm Ben Rayo, and I look forward to seeing you on the next episode.